Volatility continues to be the theme for the broader market. When it comes to the U.S. equity averages, investors continue to see clues regarding recent major market moves. Now, some things such as high-yield bonds continue to be watched as a predictive indicator. I'm here at the NASDAQ MarketSite with Chris Gaffney, President of World Markets at TIAA Bank. And Chris joins me to talk about the bigger picture as well as gold. Chris, great to have you here today.
Thank you. It's a pleasure.
Well, it's hard to believe, but the year is almost over. So that means a lot of people are looking forward to 2019. But I want to start out by looking at gold. Now, last time we spoke, which was in the summer, gold prices were below 1,200. But we continue to see gold prices not gaining as much as expected given all the volatility in the market. So what's up ahead for the precious metal?
Yeah, investors really haven't moved back into the precious metals as a safe haven. We did expect to see some of that buying occur as this volatility has hit the markets. But, I think there's a number of factors that continue to weigh on the price of gold, mainly a stronger U.S. dollar and interest rate expectations where, we do expect the Fed to continue raising rates. And that has really not encouraged investors to move back into the precious metals and gold in particular.
Mm-hmm. And sticking to the commodity space, so we've been seeing a lot of pressure for oil prices. Both WTI as well as Brent prices have been dipping recently.
Right.
And that may be good for gas prices, especially ahead of the holiday driving season here in the U.S. But it's interesting because we saw U.S. retail sales come out and we saw that they did better in terms of headline. But given everything that's happening in the energy space, that has ramifications for the broader market as well. So where are you watching out for in terms of risk?
Yeah, the main risk is growth, and I think that oil is reading a little bit. You have some questions whether it's a supply or a demand equation as far as the drop in prices, and certainly demand questions, certainly growth in China, and worries about a general global growth slowdown. We heard that with a lot of the third quarter earnings reports that forward-looking guidance was all negative, and business confidence may be starting to decline a bit. There's the trade worries, of course, but I think the main risk to the markets and in general, the macro risk is a slowing global economy, and as the Fed continues to rise interest rates, if we start to see a slowdown, that could certainly accelerate, and China is of particular interest right now.
Mm-hmm. And indeed, we'll continue to monitor economic data that comes out, not just from the U.S., but overseas.
Right.
And as you mentioned, there are concerns about how higher rates from the Fed will affect global growth. But also, another topic of concern is Brexit. Mm-hmm. Now, we'll have to see how that unfolds. But in terms of currencies, we saw the British pound dip. So I do want to get your take on commodity currencies as well as the FX market overall. What do you expect to see? Well,
we saw Aussie move up a little bit yesterday, gain a little strength recently, and the commodities again are going to be dependent on China. I hate to keep going back to China. I think the U.S. dollar is going to hold the hammer here going into year end and at the beginning of 2019, simply because of interest rate differentials. That is going to support a stronger dollar on the short term. But I do think there's some opportunities in some of the commodity-based currencies, even with oil dropping. Those that are dependent on oil, obviously that could weigh on those economies. But some of the ag commodities, Brazil is an emerging market that, with their new leadership there, and they've been able to take and move some of the soybean production to China. Exports into China have increased. That's their largest trading partner. I think Brazil is a currency that we could see a rebound on the emerging market sector. We also like the Aussie dollar, depending on what happens with interest rates there. as other central banks start to raise interest rates, I think you see that help those currencies, and especially if the U.S. is starting to look at a pause, and that's going to be the shift. That's what we're looking. That will really shift the tide in that if the Fed starts talking about possibly pausing their interest rate cycle, and the rest of the world continues to raise. That's what we saw going into 2017 when we saw the dollar start to drop, and that could happen again. And it would certainly be helpful to the precious metals if we saw the dollar start to decline again.
Mm-hmm. I'm sure we'll continue to keep an eye on the U.S. dollar as we head into the end of the year. But as we head into the new year, we'll continue to watch what happens in terms of tariffs as well as global interest rates. But when we take a look into the future, none of us have a crystal ball. And I think a lot of people are concerned, what do the recent sell-offs mean and what does it mean for individual sectors? And we know that some people have been keeping an eye on junk bonds for an indicator of whether or not this means something dire for the near future. But what are you paying attention to?
Yeah, and I do think you have to look at the high yield sector. Those are some of the most impacted by higher rates and any indication of slower growth, because they're the most fragile companies, and they're going to get hit the hardest. But you know, I think I'm overly optimistic. Overall, I'm pretty optimistic still, and I think global growth will continue. I think the trade war is something you have to look very closely at, because it involves two of the largest global economies, China and the U.S. So that is certainly something we're going to keep an eye on. At the same time, we're going to look at the interest rates, and I think what's going to impact the Fed's decision is confidence. So if we can really keep an eye on business confidence and investor confidence, any indication of a drop in business confidence going forward may force the hand of both the Fed to start slowing down, and may force better trade negotiations. So, you know, if the administration sees that the trade war is starting to really weigh on business confidence, and that's starting to impact decisions going forward, I think that that could force their hand and bring them back to the table. So I'm pretty optimistic, but you know, there are certainly some risks out there.
Mm-hmm. And I do have one last question for you, Chris. Since you mentioned the Fed, I do want to ask about Jerome Powell's latest comments. There are expectations that another rate hike is coming up in December. But what do you think it would take for the Fed to ease back in the new year?
Yeah, and I think that if we fail to see inflation picking up, and you see indications that global growth are starting to slow down, that is what will cause that pause. And one thing that I don't think the market really picked up on too much was twice now he's talked about the amount of debts and deficits and the unsustainable path that the U.S. is on as far as fiscal debts and deficits. So you know, if that begins to become a topic of conversation, you know, higher rates certainly are going to make it very difficult for the amount of debt that's on the books, and you know, the debt service is going to get very expensive and start pulling away from other spending. So you know, that may be another indicator that they're going to pause.
Mm-hmm. Okay, Chris, well, thank you so much for joining me here at the NASDAQ MarketSite, and thanks for all your insights.
Thank you.